Ever pondered how to get your money off the bench and into the game? Well, let's talk about investing. A concept that's as simple and as complex as you make it. At its core, investing is about laying out money today with the expectation of getting more money back in the future. It's about making your money work for you. Now, why is investing important? Well, simply put, you want your money to grow. You want to build wealth over time, not just for a comfortable retirement, but also perhaps to accomplish financial goals like buying a house, funding your kids' education, starting a business, or even exploring the world. Investing is one of the best ways to achieve these long-term goals. Let's talk about a little magic called compound interest. Think of it as a snowball effect. You start with a small amount, and as it rolls down the hill, it picks up more snow, growing bigger and bigger as it goes. That's exactly what happens with compound interest. Your investment earns a return, and then that return earns a return, and so on. This snowball effect can result in your wealth growing exponentially over time. But here's the kicker. The earlier you start investing, the more time your money has to grow. If you start in your 20s, you have a longer runway for your investments to take off than if you start in your 40s. That's the power of time in investing. It's not just about how much you invest, but also about how long you let your investments grow. But hold up. Investing isn't just a one-way street to riches. It's not a get-rich-quick scheme. It requires patience, discipline, and an understanding of the risks involved. It's as much about managing potential losses as it is about chasing potential gains. So are you ready to dive deeper into the world of investing? Let's get started. Investing isn't a one-size-fits-all game. There are various types of investment avenues to consider. Let's start with stocks. When you buy a company's stock, you're purchasing a small piece of that company, becoming a shareholder. Stocks are typically long-term investments and can provide substantial returns if the company does well. However, they can also be volatile and carry the risk of losing your initial investment if the company underperforms. Moving on to bonds. A bond is essentially a loan you give to an organization, typically a government or corporation. In return, you receive interest payments over a fixed period and get your initial investment back when the bond matures. Bonds are generally safer than stocks, but the returns are typically lower. Next up, we have mutual funds. These are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds spread risk across many investments and are managed by professional fund managers. However, they come with management fees, and the returns depend on the fund's performance. Real estate is another popular investment avenue. This involves buying property with the expectation that its value will increase over time. It can provide a steady income stream if you rent it out, and substantial returns if property values rise. But remember, real estate requires significant upfront capital and comes with ongoing costs like maintenance and property taxes. Finally, let's talk about cryptocurrencies. These are digital or virtual currencies that use cryptography for security. Bitcoin and Ethereum are well-known examples. Cryptocurrencies can offer high returns due to their volatility, but they also carry a high level of risk and are subject to regulatory scrutiny. Now that we've explored the different types of investments, let's delve into the strategies you can employ. A sound strategy can be your compass in the investment world, but which one suits you best? Let's dive into some of the most popular strategies out there. First up, we have the buy and hold strategy. This is the Warren Buffett of investment strategies. It's tried, tested, and true. Buy and hold investors purchase stocks or other assets and hold on to them for a long period, riding out market fluctuations. This strategy is best suited for those who have a more patient long-term outlook and can stomach some market volatility. Next, let's talk about dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the asset's price. Think of it as a slow and steady race where you're more focused on consistent progress rather than quick gains. The strategy can help mitigate the impact of market volatility and is particularly beneficial for those who are investing a fixed budget over time. Lastly, we have diversification. Ever heard the saying, "Don't put all your eggs in one basket"? That's diversification in a nutshell. This strategy involves spreading your investments across a variety of assets to reduce risk. If one investment performs poorly, others might perform well, balancing out your overall performance. It's a strategy that's well suited for investors who prefer to spread their risk and not be overly reliant on the performance of a single asset. Each of these strategies has its own advantages and is suited to different types of investors. The buy and hold strategy is for those who believe in the long-term potential of their investments. Dollar cost averaging is great if you're looking for a more disciplined approach to investing. And diversification can be your safety net, providing a balance of risk and return. Remember, a strategy that works for one investor might not work for another. It's all about finding what fits your financial goals and risk tolerance. So take your time, do your research, and choose wisely. After all, the right strategy can be the key to unlocking your investment potential. As the saying goes, no risk, no reward. But how much risk should you take? And what can you potentially gain? Let's talk about the concept of risk and reward in investing. It's a fundamental principle, really. The potential for higher returns often comes with a higher level of risk. Conversely, lower risk investments may yield lower returns. It's a delicate balance, a dance of sorts, where you're trying to maximize your returns without stepping too far out of your comfort zone. Let's consider stocks, for instance. They're volatile, subject to the ebb and flow of the market. One day you could be riding high, the next you could find yourself in a slump. But over the long term, stocks have historically offered substantial returns. Then you have bonds. They're typically less risky than stocks, but the potential returns are also generally lower. But hey, what you're getting is a sense of security. You know what they say, slow and steady wins the race. Real estate is another investment avenue. It's tangible, it's real, and it's generally considered less volatile than stocks, but it also comes with its own set of risks, like market fluctuations and property maintenance. And who can forget cryptocurrencies? They're the wild cards of the investment world, highly unpredictable, highly volatile, but with the potential for sky-high returns, or the potential for significant losses. It's a high-stakes game, that one. The key here is to balance your risk and reward. It's about understanding your financial goals, your risk tolerance, and your investment horizon. It's about diversifying your portfolio to spread the risk and potentially increase your overall returns. It's not about putting all your eggs in one basket, but rather spreading them out to mitigate potential losses. Remember, investing isn't a sprint, it's a marathon. It's about playing the long game, sticking to your strategy, and adjusting as necessary. Understanding the risks and potential gains is crucial in making informed investment decisions. So arm yourself with knowledge, be patient, be persistent, and you could very well find yourself on the road to financial success. Now that we've navigated through the basics of investing, let's recap what we've learned. We began with an introduction to investing, where we broke down the concept to its core. Investing, as we discovered, is not just about stashing away money. It's about strategically placing your resources in ventures that have the potential to grow over time, be it stocks, real estate, or cryptocurrencies. It's about making your money work for you. Next, we explored different types of investments. We dove into the world of stocks, where shares of a company are bought and sold. We looked at real estate, a tangible asset that can provide a steady cash flow. We also touched on cryptocurrencies, a relatively new player in the investment field, which offer a digital alternative to traditional currencies. From there, we moved on to investment strategies. We learned that a good strategy is tailored to individual goals, risk tolerance, and investment horizon. We discussed the importance of diversification, which can help spread risk. We also talked about the buy and hold strategy, a long-term investment approach that involves purchasing an investment and holding onto it for a substantial period of time despite market fluctuations. Then, we delved into the risks and potential gains associated with investing. We discovered that all investments come with a certain level of risk, and the potential for high returns often comes with a higher risk. Balancing risk and reward is crucial in investing. We learned that understanding your risk tolerance and making informed decisions can help manage potential losses. So what have we learned? Investing is not just about making money. It's about understanding the market, making informed decisions, and strategically placing your resources. It's about balancing risk and reward, and constantly learning and adapting. Investing can be a journey. With the right knowledge and strategy, you can make your money work for you. Until next time, remember, your financial future is in your hands.